I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. On the bottom of the screen, we are giving out a free report today, how to avoid outliving your money during retirement. You can visit my website to receive that free report. It's perfect for pre-retirees and retirees. You know, we've had a lot of turmoil, not only in the economy over the last 4 or 5 years, but we've also had a lot of turmoil in the equity-based markets, especially in 2008. One of the things that I wanted to talk a little bit about today before I start taking calls with your questions is emotional investing. I've been managing money for 27 years. I can't tell you how many calls on a regular basis into all of our offices we keep getting from emotional investors who believe the sky's falling and the world's coming to an end. And I know investing and your money going up and down and losing money can be emotional. And unfortunately, too many investors let emotions dictate and rule how they're going to invest. There's other news programs out there that talk about investing, and normally the guests are Wall Street talking heads, as I call them, that basically give you information that is pretty much worthless. They talk about, well, the market's going to be here or the market's going to be there. All opinion, no fact. At the end of the day, what gets investors in trouble 100% of the time is emotion. And the reason emotions usually run rampant around your investments is because you do not have an actual investment strategy. An investment strategy is kind of like baking a cake or cooking a recipe in the kitchen. Before you're going to be successful baking a cake, you have to pull out a recipe card. If you follow the recipe card with the right ingredients, the right mixture, you cook it in the oven at the right temperature and for the right period of time, you have a good chance of success. Investing is no different. So ask yourself this: do you actually have a written investment strategy when you buy and when you sell, and what you buy and what you sell? If you don't have a clear copy of that investment strategy, if you're managing your own money, you're shooting from the hip and you're basing your decisions on emotion. It's no wonder why the average investor loses more money and underperforms the market year after year. If you're dealing with a so-called advisor, not a money management firm, and by the way, Wall Street and their brokers and insurance agents are not money managers. So if you're not under a registered investment advisor agreement, you then have a brokerage account. You might have a nice advisor, but his job is really brokerage, and he's using a title that's often misleading and not factual on what that person really does. So again, if you're using somebody, find out if you're under a registered investment advisory agreement, and then ask for a written copy of the investment strategy, which includes risk management and when to sell, from your advisor. If he can clearly give you one of those in writing, not verbally, then that means you probably have a real money management firm. If you get a lot of hoopla and back and forth and no documents produced, investment strategy in writing or registered investment advisory agreement, I can pretty much guarantee you probably have a salesman or a broker, or what we call a wolf in sheep's clothing. I'm going to take your phone calls about your portfolio. So whether you own a stock or a bond, maybe you own mutual funds, maybe somebody unfortunately sold you 3 or 4 annuities and you're realizing that's not the best thing for your portfolio. If you want a straightforward answer, without the sales jargon, without somebody giving you the pressure to buy something that's better for their firm than for you, call me in the studio. I love taking calls. When you do call that number, all you're going to do is call that number. One of my studio producers will take your call, and then he'll get the information to me right here on the TV. So you don't have to go on TV with your question, but we'll take it on the phone, and I'll make sure that I answered on the TV show. By the way, that free report, How to Avoid Outliving Your Money During Retirement, is available on my website. Go there right now, ReznyWealth.com. You can see on the bottom of your screen we've got a flashing box that basically tells you go to ReznyWealth.com. Not only can you get that free report, but you can sign up for our newsletter that comes out every Monday, and they're all free, by the way. Great education. So again, if you're retired, you're thinking about retirement, you want to make sure that you do the right things with your money and you're not taken advantage of, go to my website, ReznyWealth.com right now. Download that report. It is free and valuable. Numbers on the bottom of the screen. I want to go to my first call today. Bill in Marco Island. My advisor is pushing hard for me to buy an Equitrust Market 12 Index Annuity. What do you think? Bill, you've got a salesman. Bottom line is this. Equity index annuities are some of the most complex investments of all investments in the investment world. In fact, FINRA, who governs the stock brokerage industry, and the SEC, Security and Exchange Commission, who oversee registered investment advisors, both put out public warnings warning seniors and investors about the complexity of these products, the misleading advertising and sales that most of these salespeople sell these. The particular product you're talking about, Bill, I've had a few other calls or emails or questions on my radio show about a similar product. Let me tell you how complex these products are and why you don't want to touch an equity index annuity. Now, the person selling that to you is a nice guy or a nice woman. Bottom line, their interests are different than yours. They're not working in a fiduciary capacity. They're working under what's called suitability. On the particular product you mentioned, first off, when you buy this product, the person selling it to you probably tells you you're going to make stock market-like returns, but without any risk. That's a complete lie. You're going to make a fraction of the stock market if, in fact, the stock market goes up. The problem with this product, the most you can make in a given year if you pick their year-to-year point-to-point is only 3%. That's it. That's the maximum you can make in any given year. The guaranteed rate of return is 1% on your money. But the 1% is only on 85% of your money. What? What I mean by that is they take your $100,000 investment, they drop it down to $85,000, they calculate the 1% on that. That's a bunch of shenanigans. Worse yet, when you buy that product, it has a 14-year surrender penalty to get your own money, and get this, that penalty starts off at 20%. Now, Equitrust is not the only insurance company that sells equity index annuities. There's about 4 or 5 major players, and there's another half a dozen smaller players. Most of these products are pretty similar. Low rates of return, lockup periods often as high as 22 years, with surrender penalty as high as 20%. The guarantees are only as good as the insurance company. So the bottom line is this: if that insurance company goes insolvent, you could lose some or possibly all of your money. So again, that guarantee is only as good as the insurance company and the solvency of it. What I'm going to tell you is this: never, ever, Bill, buy an equity index-based annuity. These things are garbage. They insanely lock your money up, and they're sold by people that have usually no more than an insurance license who want to line their pocket and not your portfolio. What I would suggest, Bill, is call my office for a consultation. If you want a real firm that's really going to help you manage your money and control risk, you want to find a fee-only registered investment advisor. Any fee-only registered investment advisor would never want to look at one of these products because they're so bad. I would never touch one of these for you, the client, because it's not in your best interest, and there's way better options that do not insanely lock your money up for 14 years and cost you a 20% surrender to get your own money. That is crazy. I'm going to take more calls in a minute. I'm going to go to a quick break, and I'll be right back. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. And we're back. Hi, I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. By the way, we're going to put our website up on the bottom of the screen. We do have a free report today. If you visit my website, again, the report is free. It's called How to Avoid Outliving Your Money During Retirement. Great for pre-retirees and if you're already retired. We cover 3 big risks that happen to every retiree. You want to avoid these at all costs. The report is free. Just go to my website, reznywealth.com. Of course, I'm taking more questions. You know, that last caller about equity index annuities, we also have some free articles on my website. If you go to the Investor Resource tab, we'll give you some information about equity index annuities and why we feel they are dangerous to your wealth. Thomas in Fort Myers, I am mainly in bond funds and I'm down about 5% in June. Is there more downside for bonds? Thomas, I firmly believe there is. This is probably the first month that investors are finally opening their statements after June was over and realizing, holy cow, bonds go down in value. But I'm going to tell you this, Thomas, the pain is not over. If you've overloaded your portfolio in too much bonds, you're ultimately going to be hurt as interest rates go up. Remember, when interest rates go up, bond values and bond funds go down in value. The longer the maturity, the more it can go down. So you can shorten the maturity, let's say to a 2 or 3 year average maturity bond or bond fund, and you'll have less fluctuation. But the problem is you're still going to make almost zero return or low returns, and you're still going to be subject to principal loss. What I would tell you is this. You really need to relook at your portfolio, the strategy that you're trying to accomplish, and I think too many retirees have a false sense of security when they put too much money in bonds. There's alternative income investments, and there's ways to manage risk in a portfolio, and by unfortunately owning too many bonds or bond funds, Thomas, you're going to continue to see the pain over a long period of time, as I firmly believe we're going to see, in this economy, we're going to see slow interest rate increases that are going to have a negative impact on your portfolio, the returns, and your net worth. Steve in Naples, PIMCO Total Return Mutual Fund versus the ETF. Which one would you prefer? Great question, Steve. I've actually received a lot of questions about the PIMCO Total Return Fund and the ETF that basically mimics, or is supposed to mimic, the actual mutual fund itself. If I was going to buy one, I would look at the ETF versus the mutual fund. But I would not own either one right now for a simple reason. They are both too big an asset base. The duration of the bonds and the investments they're buying are the wrong kind for this environment, in my opinion. And I feel that if you buy either the ETF on the PIMCO Total Return Fund or the mutual fund, you are going to get substandards to low rates of return and even potential losses if rates continue to slowly move up. I would not own either one. But when we get to a point in the interest rate cycle, which could be many years off, I would prefer the ETF version simply because of the cost structure, and I believe the flexibility currently that they have, because the asset size of that is much smaller than the mutual fund itself. If you're like Steve and you have a question about your portfolio, you can see the number on the bottom of the screen. Call me with your question. You can talk to a studio producer. You'll give your question to a studio producer like Steve did, and I'll answer your question while you listen on the TV. By the way, you can always call my office for a consultation. We do have offices in Naples and in Fort Myers. We always love talking to serious investors who are concerned and want real investment management, which includes risk management. So if you're serious about your portfolio, if you're concerned about the lack of real management you're getting, and you want to experience the difference Rezny Wealth Management offers, call our office number, 800-618-8577. Sammy in Fort Myers. My friend who's a stockbroker has advised me to purchase some stocks. As I don't have enough money, he told me to get a personal loan. Big mistake, Sammy. Let me tell you what. First off, the broker is breaking FINRA law. A broker or any investment person is not supposed to tell you to go borrow money to invest. That is completely wrong. Do not borrow money that you don't have to put in assets that have potential risk. That's a mistake. Also, your broker's a broker. He's a salesman by definition. He probably knows less about the stock market than you do. And what I would say to you is this: if you have a small amount of money, the last thing you want to be doing is buying individual stocks. Too much risk. If you're looking to start investing and you have small amounts of money, what I would tell you is use the preferred investment in a low-cost structure environment, which is called an ETF, an exchange-traded fund. Now, the broker probably didn't talk to you about ETFs because the broker doesn't really make much commission on selling ETFs. He wants to sell things that typically have bigger markups or bigger commissions, which is often stocks or mutual funds or annuities. At the end of the day, Sammy, your friend's a friend. Do not get commingled with your friend on investing, especially when you're dealing with a stockbroker who's, again, his duty is to himself and his firm because he works under suitability. If you want to have real help, find yourself a fee-only registered investment advisor who charges you a fee to manage your money and works in a fiduciary capacity. If you're like Sammy and you have a question about your portfolio, please call me in the studio right now, 239-417-4711. You know, I've been getting a lot of calls and questions, by the way, about ETFs or exchange-traded funds. They are somewhat similar to a mutual fund, except they basically buy a static index or a basket of the investments that are in that index. As an example, since most mutual funds, in fact about 80%, underperform their base index and have substantially higher expenses than an ETF, why would an investor want to buy most mutual funds when they could buy a low-cost ETF? Simple. Your broker or so-called advisor doesn't make any money when they sell you an ETF. They make a lot more selling you a mutual fund, and most of these mutual funds have lousy performance and exceptionally high expenses that take away from your portfolio. So again, the preferred investment would be an ETF or exchange-traded fund. There's over 1,000 of them today, and you can find ETFs that cover everything from gold to the S&P 500 to everything in the middle. It's a great vehicle whether you're rich or you're of modest means and you're just starting out, because you get instant diversification at a low overall cost without the risk of buying individual stocks that take a lot more research, a lot more discipline, and experience before you buy those. David in Fort Myers, what happens to my shares if I own a company stock and that company files for bankruptcy? David, if you own stock and that company goes out of business, you could lose all of your money, and chances are in a bankruptcy you probably will. I'll give you an example. You've recently heard that Detroit has filed for bankruptcy. Of course, people who own municipal bonds in Detroit are probably going to get wiped out. If they don't get completely wiped out, they'll probably get pennies on the dollar. So what I always tell investors is this: if you own any individual stock or you buy individual bonds, never own more than 5% of any one individual stock or any one bond. And that's assuming you're more of a growth investor. If you want to be a little bit more conservative, never own more than 3% of any one individual bond or any one individual stock. This way you can diversify out more. Better yet, my last example was, look at ETFs, exchange-traded funds. There's actually ETFs that actually buy baskets of muni bonds, municipal bonds, and or stocks. So remember, instead of going overboard on one stock or one bond, no more than 5 if you're more trying to grow the portfolio. I would recommend 3 for more conservative investors. I'm going to take a short break. I'll be right back with more calls after this. Please visit my website, ReznyWealth.com, so you can get a copy of that free report. I'll be right back with your questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risk to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. Hello, I hope you're enjoying today's program. We're of course are live every Wednesday, and we do rebroadcast on Sunday evenings. Remember, I also do a live radio show throughout Florida, syndicated, every Sunday from 10 to noon Eastern. You can pick me up. If you want to find available stations, go to my website, ReznyWealth.com, and you'll see a button right there on the home screen that'll basically say, here's the stations Brian is on and the times his show is broadcast. We always love getting questions from our TV and our radio listeners. And as I always suggest, if you're unsure about your portfolio, if you're realizing that maybe you're not really getting any real advice and you don't have that investment strategy, which includes risk management, which is the most important part of money management, call my firm for a consultation. We work in a fiduciary capacity. We are a fee-only money management firm, and we have offices conveniently located in Naples and in Fort Myers. Jeff in Fort Myers, in a recent column, you used the term 200-day moving average. What does that mean? The 200-day moving average is basically the average of a daily price of either a stock or an index. As an example, if I looked at the S&P 500, and let's say the current price is 1,650 as a number, the 200-day moving average is the average price for the S&P 500 over the last 200 days. I like to use the 200-day moving average as a simple glance of a long-term trend. Typically, if the price of a stock or the S&P itself is trading above its 200-day moving average, it means it's in an uptrend. That is usually positive. If a price of a stock or the S&P or any index itself is below its 200-day moving average, it means it's in a downtrend and typically is a sell signal or a warning sign when that crosses below. So the 200-day moving average is a very useful tool. It's not the only tool, but I think it's a great one. One of the things I try to educate all of our clients and my radio listeners, in addition to you on TV, is use charts. Moving averages and a picture can tell a lot about the direction of the investment that you own. Remember, relatively stronger investments typically outperform. Relatively weaker assets in a downtrend historically underperform over various time frames. We at Rezny Wealth Management use charts. We also use what's called relative strength, which I have found in my 27 years managing money is probably the number one best way to look at direction of that asset category that you're either in if you want to keep holding it and or if you want to add it to your portfolio. Bill in Punta Gorda. Detroit filed for bankruptcy last week, and I have some muni bonds. What will happen to them? Bill, if you have money in municipal bonds in Detroit, if they're not insured, which a lot of their bonds are not, you're going to lose some or all of your money, bottom line. I hope you didn't have more than 5% of your portfolio in Detroit bonds. Often people will chase yield. Detroit's been paying higher yields because they've been in such bad shape and they've been downgraded by the rating agencies. So what happens? Investors want to chase what's paying the highest yield, not understanding the risks they take. And a lot of investors think they're going to get the bailout. I hope the government, to be honest with you, does not bail out Detroit. You made an investment. Don't own more than 5% of any one individual stock or security. At the end of the day, it's called investing. This is exactly the reason why I tell investors you need to have an investment strategy, and part of that strategy is when to sell. If you had a sell strategy, you would have sold Detroit bonds many moons ago in order to protect your portfolio. Remember, before you buy any investment, and I don't care if it's a stock, a bond, real estate, oil, or gold, before you buy it, you need to know what is going to cause a sell in your portfolio so you don't ride it all the way down 50 or 100%, which I see too many investors fall prey to. And one of the biggest reasons is they often are using a brokerage firm or an insurance agent who actually doesn't manage your money, doesn't have an investment strategy, and certainly doesn't know when to sell. Bob in Key West, Florida. I'm a retired investor. Is it time to consider a new investment strategy away from bonds? Bob, you should have designed a new strategy a long time ago. Bottom line is I think too many retirees overloaded the boat in bonds. That party is overdone, finished. If you own too much money, especially in intermediate to long-term bonds, meaning bonds longer than 5 years, I think you're making a big mistake. Now, you could trim your bond exposure to 2 and 3 year maturities, and if you had maybe 30, 40, 50%, maybe that would make sense. But at the end of the day, you need to look for other income alternative investments that can still give you an income. Remember, bonds are the riskiest when they're at the bottom of the interest rate cycle. I would tell you it's time to talk to a professional money management firm like my firm. You are more than welcome to call us at any time. I'm going to put our number at the bottom of the screen. And I'm also going to put our website up so you can sign up for our free report, How to Avoid Outliving Your Money, and you can also go to my website to sign up for a consultation. Our website is reznywealth.com, and again, that free report, How to Avoid Outliving Your Money During Retirement. I don't care if you're retired or you're a pre-retiree, that report is a must-read for any serious investor. Mitch in Marco Island, Florida. How do I check out my broker and his firm? Mitch, I wish more investors would ask that question. And the fact is, the sad fact, about 99% of investors never ever check out the brokerage firm or the firm they entrust their money to. You should do that immediately, even if you're dealing with a firm. In fact, you would be shocked and appalled at some of these brokerage firms, how big a rap sheet that they have against their clients and how many times they've been arbitrated or sued or fined and censured either through FINRA or the SEC. The site you want to go to is FINRA, F-I-N-R-A, FINRA.org, and that's to check out brokers and brokerage firms. What you really want to check is the brokerage firm, because that's the bad umbrella that usually the broker works under. So check out the firm, not necessarily the broker. So go to FINRA.org. If you're checking out registered investment advisory firms like Rezny Wealth Management, you would go to SEC.gov. That's where you want to go there for registered investment advisory firms. I always encourage investors to check out the firms that they entrust their money with before you hire them and after. In fact, if you'd like, go to my website, reznywealth.com, for free at the top of the homepage. You'll see a free questionnaire that lists all these facts. It's called the Fiduciary versus Suitability Questionnaire, and it's going to tell you why it's important to check out your broker and or his firm. Folks, I'm getting close to out of time, so I'm not going to take any more questions. I want to wrap up a little bit. Times are changing. The days of buying and holding a basket of mutual funds or stocks are over. You need an active strategy, and sometimes that means making changes to your portfolio when your investment strategy dictates it. Buy and hold is going to get you into trouble if you own assets that are inappropriate for today's cycle. I leave you with that. Better yet, if you're unhappy with your portfolio or you're concerned or maybe you just want to talk to me about managing your wealth, you would benefit from a consultation with my firm if you want to sleep well at night, you want less stress over your investments, and you want to enjoy retirement with your family. I always tell investors, there is a difference when you hire Rezny Wealth Management. We invite you to experience it. Please call the number on the bottom of the screen right now, and please visit our website, reznywealth.com. We would love to help you in your retirement and help you sleep at night and enjoy your family. Have a great evening.